Okay, so you want to own a Dollar General. There are more Dollar Generals in America than McDonald's, Starbucks, and Walmart combined. 20,000 of them, almost all in small towns where they're the only store for miles. So you assume the owner lives above the shop or somewhere nearby. They don't. The person who owns that building might live 1,000 miles away and has never once walked through the door. They didn't build the business. They bought the building underneath it and rent it back to the company for 15 years. By the end of this video, you'll understand exactly how that works, why Wall Street quietly considers it one of the safest real estate bets in America, and why it works best when there's nowhere else in town left to shop. If you want to actually understand how businesses like this work, not the version people assume, subscribe now. Let's start with what you're actually buying. There are more than 20,000 Dollar General stores across 48 states. That's more locations than Target, Kroger, and Costco combined. Most people assume that scale means franchise opportunity. It doesn't. Dollar General has never sold a single franchise in its entire history to anyone. Every store is corporate-owned and corporate-run, from the shelves to the staff to the signage. So if you want in, you're not buying a business. You're buying real estate and leasing it to one. This is called a triple net lease, or a CNNN for short, and it's one of the most common structures in American commercial real estate. Even though most shoppers have never heard the term, an investor buys the land and the building. Dollar General signs a 15-year lease. And for those 15 years, Dollar General pays for everything: property taxes, insurance, roof repairs, parking lot maintenance, every single operating expense that would normally fall on a landlord. The investor collects a rent check and does almost nothing else, month after month, year after year. It sounds like the easiest real estate deal in America, and for a while, that reputation held up. Dollar General started in 1939 in Scottsville, Kentucky as a single, family-run store. For decades, it grew slowly, the way most retailers did, one town at a time, on its own dime. Then, starting in the early 2000s, the growth strategy changed completely. Instead of building stores and holding on to the real estate, the company began selling the buildings to outside investors the moment construction finished, and leasing them straight back for 15 years. That single decision turned Dollar General from a retailer into something closer to a real estate machine that happens to sell canned goods and cleaning supplies out of the front of each building. It freed up enormous amounts of capital. Instead of that capital sitting in buildings, it went straight into opening the next 500 stores, and the next 500 after that. Wall Street started calling this a build-to-suit and sell-leaseback strategy, and it became the engine of the entire chain. Here's why investors line up for these deals. Dollar General carries an investment-grade credit rating from major agencies including S&P and Moody's. That means the company is considered financially reliable enough to guarantee a lease for 15 years straight. The stores themselves are cheap to build and cheap to run. A typical location is about 9,000 square feet on a single acre of land. Roughly 70% of Dollar General stores sit in towns of under 20,000 people, places where Walmart doesn't bother building, and the nearest full supermarket is 30 minutes away by car. New properties typically sell for $1 million to $2.5 million, depending on the local market. That's a small enough price tag that individual investors, not just pension funds, can realistically buy in. Cap rates on these deals run between 6.2 and 7.15%, depending on lease term and location quality. That's meaningfully higher than the yield on Dollar General's own corporate bonds, which sit closer to 5.3%. The gap between those two numbers is called the spread, and it's the entire reason this trade exists. Investors get paid extra, in real estate form, for taking on risk a bondholder never has to take. On paper, it looks like the safest, simplest income property available anywhere in American retail. No tenants to screen, no leases to renegotiate every year, no vacancy to chase for at least a decade and a half. Compare that to owning an apartment building or a strip mall with 6 different tenants. An apartment owner deals with late rent, broken pipes, and tenant turnover every single year. A strip mall owner juggles 6 separate leases, 6 separate businesses, and 6 separate risks of failure. A Dollar General investor deals with exactly 1 tenant, 1 lease, and 1 corporate guarantee behind it. That simplicity is precisely what net lease brokers sell hardest at investment conferences across the country. They call it mailbox money because, in theory, all you do is open the mailbox and find a check. Financial advisors recommend these deals to retirees rolling proceeds out of a sold business, almost as a category. Real estate investment trusts buy hundreds of these properties at once, bundling them into portfolios that trade on public markets, giving ordinary investors indirect exposure to the exact same rent checks. Some of the largest net lease trusts in the country hold thousands of Dollar General leases combined, alongside similar properties from pharmacies, auto parts stores, and fast food drive-thrus as salads. To Wall Street, a Dollar General lease and a Walgreens lease look almost identical on a spreadsheet. Both are long-term, corporate guaranteed, and backed by companies with investment-grade credit ratings. The building could just as easily hold a different name on the sign. What matters to the investor is the paper, not the products sitting on the shelves inside it. Here's the part that should bother you. The investor who owns the building has no say in whether the store stays profitable, no say in what's on the shelves, no say in staffing, pricing, or hours. None of that matters as long as the rent check clears every single month. And the rent check is guaranteed to clear for exactly one reason. The tenant that signs it has structured its entire business around being the only real option a town has left, whether that town likes it or not. Think about how strange that actually is once you say it out loud. An investor's 15 years of guaranteed income depends on a town staying just poor enough, just remote enough, and just underserved enough that nothing better ever moves in it next door. A thriving Main Street with 3 grocers competing on price would actually hurt this specific investment. Competition is the enemy of the rent check, not the friend of it. That's the opposite of how most people assume real estate investing is supposed to work. For decades, small-town America had a Main Street with a hardware store, a grocer, a pharmacy. Then something changed. Dollar General began opening 450 to 500 new stores every single year, year after year, not in cities, in the gaps. The town's too small for a supermarket chain, too rural for a big box store to bother with. By the time a Dollar General opens, it's often the only retail option within 10 miles. That's not an accident. It's the entire site selection strategy, written into internal company planning for decades, down to the mile radius. And it works, financially, exactly as designed. When there's no competing grocer nearby, the store doesn't need to discount. It doesn't need to innovate. It doesn't need to compete on selection, freshness, or service. It just needs to exist, and the town has nowhere else to go. You might live in a town like this right now. You might already do most of your shopping there, not because you love it, but because the alternative is a 40-minute drive each way. Here's the villain in this story. It isn't Dollar General itself sitting behind the counter ringing up your groceries. It's the real estate model built around it. An investor 1,000 miles away collecting a fixed rent check every month with a direct financial incentive to see no other store ever open in that town again. The worse the local options get, the more valuable that investor's building becomes. Every dollar you spend there because you have no other choice flows past the cashier, past the regional office, and into a rent payment for someone who has never set foot in your zip code and never will. That investor doesn't need the town to thrive. They need the town to stay exactly desperate enough that Dollar General remains the only answer. Researchers who study rural retail have documented this pattern in county after county. Independent grocers within a few miles of a new Dollar General often see sales decline within 2 years. Some close entirely within 5. When that grocer closes, the town doesn't just lose a place to shop. It loses fresh produce, since most Dollar General locations stock almost none. It loses local jobs that paid into that grocer's payroll for years, sometimes decades. And it loses whatever leverage it once had to negotiate prices, because there's no competing checkout line left. None of that shows up on the rent roll and investor reviews before signing. None of it shows up in the cap rate, the credit rating, or the glossy offering memorandum either. It shows up 2 counties over, in a town most investors will never actually drive through. If you've never thought about who actually profits when your town loses its last grocery store, subscribe now because the numbers behind this get a lot stranger from here. So who's actually on the other end of that rent check? Meet someone we'll call Walter. He spent 30 years running a small manufacturing supply business outside Columbus, Ohio. He sold it in his early 60s and needed somewhere to put the proceeds that wouldn't demand his time, his attention, or another 30 years of his life. A broker showed him a single Dollar General property just outside Zanesville. Purchase price, $1.4 million. 15-year lease, corporate guaranteed, rent increasing 10% every 5 years like clockwork. Walter has never met the store manager. He has never restocked a shelf, fixed a broken freezer, or dealt with an angry customer. Once a year, a rent check arrives. Once a year, he drives out and checks the roof for damage, mostly out of habit. That's the entire relationship, start to finish, for 15 years running. For Walter, it's the closest thing to owning a bond that happens to pay real estate returns. For the town outside Zanesville, it's the only place within 15 minutes to buy milk, bread, or diapers. Those two facts are directly connected, and neither side thinks about the other very often. Walter isn't a villain in any personal sense. He built a business for 30 years and wanted a quiet, predictable retirement. He just happens to be standing on the other end of a structure that only works this well because an entire town's options have narrowed down to one building. Walter's broker didn't mention any of that when they closed the deal. The pitch was about the credit rating, the 15-year term, and the corporate guarantee behind it. Nobody walked Walter through what happened to the hardware store 2 blocks away 5 years earlier. Nobody mentioned the regional grocery chain that pulled out of 3 counties the year before that. Those closures weren't in the offering memorandum. They weren't in the rent roll or the lease abstract or any document Walter's lawyer reviewed. But they were the entire reason the rent check has cleared, on time, every single month since. Walter checks his account once a month, sees the deposit, and moves on with his retirement. He's never once connected that deposit to the empty storefronts on the same block. Most investors in these deals never do. Let's talk about what this actually pays and what can go wrong along the way. At a 6.5% cap rate on a $1.4 million property, Walter collects roughly $91,000 a year in rent before taxes. Out of that, Walter pays almost nothing. No property management fees, no maintenance calls in the middle of the night, no tenant turnover to chase down every few years. That's the entire appeal of an absolute triple net lease, and it's why brokers sell it so easily. But it isn't risk-free, and 2025 made that clear to a lot of investors at once. In March of that year, Moody's downgraded Dollar General's credit rating from Baa2 to Baa3. Still investment grade technically, but a step closer to the edge of that category. The downgrade didn't happen because towns stopped needing dollar stores. It happened because the company's own margins came under pressure from rising theft, higher labor costs, and years of aggressive, debt-funded expansion into new markets. When Dollar General's credit gets shakier, so does every single rent check tied to its guarantee. And there's a second risk few new investors think carefully about before signing. Dollar General occasionally closes or relocates a store to a better intersection nearby, chasing more traffic. When that happens, the old building doesn't collect any rent at all, starting the day it moves out. It sits empty in a small town with almost no other national retail tenant who wants that footprint. A single-tenant building built for one company's exact floor plan and drive-through layout is very hard to re-lease to anyone else, no matter how good the location once was. That's the trade-off underneath every single one of these deals, whether the broker mentions it or not. Guaranteed income for 15 years, backed by a company whose entire business model depends on being the only option in towns most other retailers have already written off. The same forces that make the lease valuable are the forces that make the building nearly worthless the day the lease ends badly. There's a third risk, quieter than the other two, that only shows up over time. Not every Dollar General lease is a full triple net structure, even when it's marketed that way. Older stores built more than 15 years ago sometimes carry NN leases instead of NNN ones. Under an NN lease, the landlord, not the tenant, is responsible for the roof and the structure. A single roof replacement on a 9,000 square foot building can run $80,000 to $150,000. That single expense can wipe out more than a year of collected rent in one bill. Investors who don't read the lease abstract carefully sometimes discover this only after the roof starts leaking. Brokers know the difference between an NNN and an NN lease immediately. Not every buyer asks the question before signing. Net lease attorneys who review these deals for a living say the same mistake shows up constantly. Buyers focus on the cap rate, the tenant name, and the years remaining on the term. They spend far less time on the specific clauses assigning responsibility for the roof, the parking lot, and the HVAC. A 1 percentage point difference in cap rate can look enormous on a spreadsheet. A single unexpected roof replacement can matter more to your actual return than that entire percentage point ever did. Let's close the loop with 2 real outcomes from the same starting point. Scenario 1. You buy a Dollar General property for $1.5 million at a 6.8% cap rate. Annual rent, roughly $102,000 paid in full on time for 15 straight years. Over the 15-year lease, Henschelwischkies, with a 10% rent bump every 5 years, total rent collected comes to somewhere near $1.65 million before any resale. Add likely property appreciation from land value alone, and your total return over 15 years lands somewhere between $2.2 and $2.6 million on a $1.5 million initial investment. No landlord duties, no 3 a.m. phone calls, no staff to manage, train, or replace. That's the version that gets pitched at every net lease investment seminar in the country, on repeat. Scenario 2, same property, same lease. But 5 years in, Dollar General decides to relocate to a bigger store half a mile away, near the new highway exit. Chasing better visibility and more parking, they pay the remaining rent under the existing lease, exactly as required, until the term ends. But once that term ends, you own a 9,000 square foot building built to one retailer's exact specifications, in a town with no other national tenant looking to move in. Vacancy on single-tenant retail like this can stretch past 18 months, sometimes longer. Your fixed income disappears overnight, and your resale value drops sharply along with it. You can try converting the space, but the layout, the parking, and the signage were never built for anyone else. Same purchase, same paperwork, same broker pitch on day one. One outcome makes you money for doing almost nothing for 15 straight years. The other leaves you holding an empty building in a town you've never actually visited. The difference between those two outcomes isn't luck. It's whether the town underneath that building had anywhere else to go and whether it still does. There's a third path worth mentioning, one that plenty of investors quietly choose instead. Rather than buying a single Dollar General outright, they buy shares in a net lease real estate trust that owns hundreds of these properties spread across dozens of states at once. A single vacant store in one town barely moves the needle across a portfolio that size. The trade-off is lower upside. Instead of a 6.8% cap rate on one building, the trust might yield 4.5 to 5.5%. After management fees are taken out of every dollar of rent collected across the whole portfolio. Less risk of one bad relocation wiping out your income, less control over which specific properties you actually own. For investors like Walter, used to running his own business for 30 years, that trade never felt right. He wanted one building he could drive out and look at, not a slice of 400 he'd never see. For a younger investor with less capital and less appetite for a single point of failure, the pooled version of the same trade is often the more honest way to get exposure to it. There are more Dollar Generals in America than McDonald's, Starbucks, and Walmart combined, and almost none of the people who own the buildings have ever set foot inside one. That's not a flaw in the system, it is the system. A rent check that depends on a town having nowhere else left to go, collected by someone who will never meet a single customer who pays for it every day. The store isn't really the business. The absence of any alternative is the business, and it always has been. Every year, another few hundred of these open in another few hundred small towns. And every year, the math behind them depends a little more on what closes around them. A hardware store that shuts down, a regional grocer that pulls out, a pharmacy that can't compete on price anymore. Each one of those closures makes the Dollar General next door slightly more valuable to its owner. So, okay, you wanted to own a Dollar General. You never actually wanted the store. You wanted the 15 years of certainty sitting quietly underneath it. And the certainty was never about the shelves, the staff, or the shopping. It was about how few other options the town would have left for as long as the lease runs. 20,000 of these buildings now sit across the American map, mostly in places nobody else wanted to build. Behind almost every one of them is a Walter or a retirement account or a real estate trust, collecting a rent check tied not to how well the town is doing, but to how few choices it has left. That's not a coincidence built into one bad deal. It's the business model, repeated 20,000 times in 20,000 towns, all across the country. If stories like this, the hidden owners behind the businesses you drive past every day, are what you're here for, subscribe. There's a lot more of America's economics we haven't uncovered yet.